All right, everybody, welcome to July's Meetup. We have a really exciting meetup here tonight. We're going to be talking about cash flow. We talked about some financing, and we have a special guest we'll introduce you to as well tonight. If you guys are watching the replay, welcome. For everybody live joining us here on Zoom, welcome. I hope you guys are all healthy and well. We're very thankful and excited that you guys decided to join us here tonight. And with that being said, we have a action-packed meetup. It is content heavy. I hope you guys have your notepads. I hope you guys are ready to just go berserk on typing some questions. You guys will get the slides from this as well. So if you miss something, no worries. And you'll be able to get through it as well. Like a lot of our slides, as you'll see, are pretty packed. So this is like one of the meetups here through this half of this year so far that you're going to want to look back at the slides and review on.
And we appreciate you being here when it's 25 degrees out and sunny over here on the West Coast. I know a lot of you are sitting at home doing this. And so the time that you take out to be here for us is super grateful. And we love providing this. Normally we don't do meetups in July and August because usually they're in person and those are summer months and nobody wants to come. But because we can do it online and people can do it from home, we hit it up.
Right on. Let's get going. So July 21, this is our online meetup. I hope everybody's getting accustomed to using Zoom. Thank you, sir.
No, 1 second. Let me redo that.
Oh, okay. Redo.
There we go.
Okay. So just a brief touch on tonight's agenda. We're just going to whip through our intro. And you guys will be surprised. We actually put a little bit of extra effort into it. So it's not our traditional cookie cutter piece. We added some flair and we've revised it. So that'll be new for you guys. We're going to be talking for a little bit about cash flowing deals, how we're finding it, what's our system, and why we've been so successful over the last 4 years at finding cash flow in a place you can't find cash flow. And then Kyle Green's going to have a quick jump in and we'll wrap it up. For everybody who's new and for everybody who's just on, please just say hi, where you're from, what you're up to. As I said before, like your guys' energy, we can feel, even though this is through this Zoom. And Randy, myself, and Kyle, we all thrive off of audience energy. So be engaged, ask questions here in the chat, and wave or get excited and all that kind of stuff. And we just want to welcome everybody for tuning in, and thank you.
And showing where you're from is cool because maybe there's somebody else in your area that you haven't met before. You can reach out to them, send a personal message. Just a nice way to connect.
So who are we? We wear a couple of different hats. We are full-time real estate investors. We are educators. And just recently, we have officially become developers, which we are very excited about. And so we started our company in 2016. We knew that there was a bigger mission and a bigger impact that we could create. And so we've done a lot of collaboration, a lot of partnership. Through our investments, we have done over $8 million in transactions. We've done everything from single family, we've done flips, we've done small multis, we've done developments. We've raised over $4 million in investment capital, and everything in our portfolio has been done with OPM and investors capital. And on the education side of things, we've been running this meetup for over 4 years now. We've done multiple 2-day workshops. We did a 4-week program. We have about 700 people in our online community, and we've done some really large events as well with 500 plus people. Our most recent one was our December charity mixer, where we raised over $12,000 for Kids Sport Victoria. Our mission statement, which I could say blind, and I think a lot of people just really love in this community, and it's something that drives us every single morning. And it's, we are on a mission to financially educate 1 million people, inspire them to invest in real estate so they can live a more fulfilled life. Kind of bargained that one up, even though I talked highly about it.
And one of the cool things that we do, as you guys know, we love giving back. That's just something that's been in our nature. It's something we built our business around and something we strive for. This year is actually Kids Sport Victoria's 20th anniversary. Steve and I are sponsoring their golf tournament, which is going to be in September, fingers crossed. And as a lot of you know, we've been able to write a lot of checks for them. Super cool. What we are excited about is this new mission that we're on. So the Go Big to Give Big movement, inspiring others to go bigger with their dreams, to give bigger with their profits. Steve and I came with this cool idea of how can we start using our rental portfolio to start giving back That's our whole purpose around real estate and investing and everything we do. So we just decided that we're going to start donating $10 per door per month. So we're going to start with one of our 5 plexes, and we're going to pledge that into donating to a charity of our choice. So we'll be donating $50 a month from this one property over to a charity, and it'll be consecutively do that as long as that property is rented. It's starting to gain a lot of traction right now. We've probably by the end of August, we'll have over 20 doors of other investors looking to do the same thing. We are looking at taking this mission across Canada, scaling it, growing it to eventually be something where we can have our own nonprofit, where people with investment properties will help us fund this nonprofit, which will go to support different charities, but probably somewhere in the space of helping people that are low income or single moms get into rentals right now, because it's just so tough for them. So it's something we're super excited about. If this is something you're interested in doing in your portfolio, we want to track it. We want to get to know it. So reach out to us, send us an email, send us a DM, anything like that. This is going to be something you'll see a lot from us come, August, September, October. We're going to be pushing this real hard with our Go Big to Give Big movement. And we are so fired up to have you all join us with it.
And we couldn't be here and support you guys and do what we do without all of our sponsors. I saw a couple of them on this call. If you're on the call, give a quick wave. Real File, they're an amazing accountant group out in Ontario, specialized with working with real estate investors. Prime Real Estate team here in Victoria, BC. Kyle Kerr, thank you, dude, if you're here. Great guy to work with if you're looking to either buy an investment property, sell one, buy a residence, whatever. I saw Megan on here earlier. Megan, give a quick wave. Century West Financial, amazing person to work with to get all your finances in order and get your investing in order. Sitka Law Group is probably the best law group that I've worked with, regardless if it's closing a real estate deal, putting together, business articles, and everything in between. They're really great to work with and really know real estate as well. And then, of course, our future guest tonight, Kyle Green with the Green Mortgage team. Again, we only work with the best, so that's why he's here tonight, and that's why they're a sponsor of ours and they're our real estate broker.
To back Sitka Law, I called them yesterday in a pickle of a deal that I'm in right now, and got some incredibly good info, and they were very timely and helped me get it done. So I just want to give them an extra shout out because they really helped me out yesterday in a pinch when I needed a lawyer for some closings, because it does happen to us.
And then, if you guys haven't seen this yet, we are doing a virtual road trip across Canada where we're interviewing real estate professionals and investors just like you and I. And we are just diving into different markets. So 2 different cities in each province, all the way coast to coast. And we're just exploring what markets are profitable, which ones aren't, what strategies work well, and then showcasing a couple of deals and the professionals in those spaces so that you can reach out and connect with them as well. So we've done, I don't know what it's been, like 8 or 10 or so. We're in Ontario right now. There's been some phenomenal interviews there, some heart-wrenching moments where it's really inspiring, and then some real kind of, if you're a data geek like me, there's a lot of information to go through. Great videos. They're in our Facebook group. We release them there first, and then they go to YouTube and are shared with the world after that. So if you want to first grab at the information and the possible deals that we share on these interviews, they come out every Tuesday and Thursday, and you'll want to jump into our Facebook group. And all you got to do is hop on Facebook and you just search up the REINVESTORS community, or even just the REINVESTORS, and you'll see this as a private group. All you have to do, click join, fill out the 3 questions, and we're rocking and rolling. And you can connect with most people on this call too.
Yeah, I'd say the majority of people in our community are on there. I think we're over 700. We're close to 700 members now, at least. Yeah. So really exciting. Something Steve and I are excited to share with you guys tonight, a little bit about how we found Cashflow. And this really stemmed from, we went back a little bit to our roots on this last property that we just closed on or are closing on here in 2 weeks. And it's just our bread and butter. And we thought, man, it'd be cool to share that with people of just what we came through and what we created when we first started. There's a lot of people in here that are looking to do their first 1 to 5 deals. And there's quite a few people as well that are in the 5 to 10 range. But we just wanted to show what we did when we first started and the opportunities that came about.
And so when we did first start, a couple of our mentors, family included, we told them what we were up to and what we were going to accomplish. And one of the things that they said was, if you wait for the market to crash, you are already losing money. And so this was, 2015, 2016, we kind of thought, market was a little hot even then, and we were hesitant, but they inspired us to put the pedal to the metal and keep looking to find a system that works.
And it's very prominent today. How many people today are saying, hey, wait for the market to crash to get in, wait for the market to crash, get in. Just find the deals instead.
And then just on our last interview, a really great realtor out in the Toronto, London area, his name is Justin. He said, I know people who are losing money fighting for multiple offers. Yet I also know there are people out there making hundreds on properties that were sitting on the market for 100 days. All you have to do is find the opportunity. And so that's really what we're talking about here today, is a system that we've used here locally in Victoria, BC, and up and down the island. We know it works in a lot of different markets across Canada, just from our interview session alone. And we're going to dig into what that system is and show you guys how to find this type of opportunity and then how to replicate this system.
So our first 3 properties that we found, we actually niched in doing duplexes. So buying half the duplex with suites in it. Now everyone has a different definition of duplex. Duplex to us is 2 single family homes attached. So we bought half of the duplex with suites in it. Every single person that we bought, when we bought them, said we are overpaying for them and that half duplexes wouldn't appreciate. But Steve and I had been mentored by some great people and taught some great stuff. All we did was run the numbers and we said, there's cash flow here. There has to be. So what we were buying is $450,000 houses that were renting for around $3,200. I generic a bit of this. We bought, about 5 properties in our first year or so. We kind of just took an average of that to get these numbers. So we're buying for about $450,000. We're doing about $25,000 cleanup renovations, nothing fancy. And then everyone told us we had to look for that 1% rule. I think anyone in Canada knows it's not real, but we created our own. So we created the 0.63% rule, which is basically you take your rents and divide it by your monthly rent and divide it by the purchase price, and it gives you a number. That down here is that 0.0063. So basically what we're doing is we're just finding properties, timesing it by 0.0063, and that would tell us what rent we would need to rent that property out for to continue making cash flow on it. And all of our properties in these areas were cash flowing over $500 a month. So this wasn't just a skinny deal. Like, this was with our vacancy. These are with all of our contingencies built into it. So we're like, damn, that's a pretty good thing. So that's how we started formulating on these properties. It just became a formula essentially for us.
So just real quick here, what that number includes is a 3% interest rate, and a 30-year amortization.
And then we just did some cleanup. So these were the properties. These are our first properties. Steve and I were just getting started. We weren't experts. We weren't doing, $100,000 to $150,000 renovations like we are now. $25,000. It's like vinyl plank flooring, paint it, and then put a little bit of cleanup in the bathroom so that they look newer, and then rent them out for good dollars. We weren't at the top of the market, but we were on the higher end. And so it was super easy. It was just a duplicated formula. We had a good contractor. He knew everything we wanted, and we made it super easy to go. The crazy thing was that we sold all 3 of those properties in 2.5 to 3 years for $600,000. All of them sold for $600,000. And all of our partners were making 19 to 24%. But had we listened to everybody that told us in the beginning, like, don't buy those properties, they're not good, don't buy them, they don't appreciate, the market's going to collapse, we wouldn't have done the deals. But what it was the cash flow. We didn't care about the appreciation. We cared about the cash flow. And this is, the formula still works today. Steve just went and analyzed the property on the right there. So the 2 on the left were some of our first properties. You can see the purchase price there around that 450 to 475 range, depending on the renovation and cleanups. Rents were pretty modest. And then those were the numbers we're getting, 0.66, 0.65, but they're all cash flowing very well. And then Steve, we just closed on this one in December, is the what property on the right, which is over here. We bought it for $755,000. And what did you do, Steve, when we bought that one literally just a few 6 months ago?
Yeah, just a couple months ago, it came on the market. It was on the market for almost 100 days, actually, because of a tenant arrangement, which we negotiated. But when I first saw the property, I was like, sweet. There's 3 bedrooms upstairs and then 2 suites down below, a 1-bedroom and a 1-bedroom. What can we get for those numbers? And does that fit the 0.63 rule? It did. And so we're like, all right, let's dig into this a little bit further. So we put together our budget, put together, where is it in Victoria, and the economics to go along with that. And all systems were green lights, and we ended up closing out in December, and I think it's fully rented as of now.
Yeah, just fully rented this month again. I did some big renovations on it over the past little while, and now it's worth quite a bit. Again, people are telling us don't buy half duplexes. They cash flow and they work. And the principle behind this, guys, isn't go look for a half a duplex. It's go look for something that the average person wouldn't want that would cash flow well in areas that look good. So one of our mentors, Cole Hatter, always had a very successful real estate career. He says, "Hey, I'm not an expert. I just did the right things at the right time," and that's what we did. We just followed a formula that worked well for us, took educated risks, and hit good timing in the market. Now, could those properties all still be worth $500,000 today? Yes. Would we still be ecstatic? Yes. We're making $500, $600, $700 a month in cash flow. We don't really care. Obviously, we're excited about where they went, and our investors were happy to exit the properties because those were the economics we talked about in a 5-year plan that we had happen in, the 2 to 3.5 or 2 to 3 years. But these are some of the things that we look at. And Steve's a big economics guy. He loves a lot more of these things, but it's simple questions that we ask ourselves going through each town. Like, we could just take this formula and duplicate it in any town across Canada. What are some of the growing factors? What are the economic stimuluses that are growing that town, right? Where's the development going in that town? Vacancy rates, are they going up and down, right? What are mortgage rates doing right now? Do we expect a rise and a fall? Those are the things that we can ask ourselves to put in into our formulas to just figure out what we're going to be getting on the outside of the properties. Anything you want to add there, Steve?
No, I think it's just, for me, the economics of it, there's macroeconomics from a global, countrywide province level. And then there's microeconomics. For us, it's the island, and then even smaller, it's, Victoria. And in Victoria, there's micro neighborhoods. In that neighborhood, there's also micro markets. And so the economics for me, it's the recipe for success. If you can find good economics, you're going to find good investments.
Taking risks, there's a fine line between a calculated risk and doing something dumb. And what we're trying to get across the point here is that although it might seem risky, although people might not believe in what you're doing, it's all about just making a calculated or educated risk. So we learned to make decisions based on calculated risk. After assessing the economic factors, we basically run ourselves through these questions. If we buy this property, so this is exactly what we were looking for. If we buy this property for $475,000 and we hold it for 5 years, we're going to collect $30,000 in positive cash flow. That's what our numbers say. That includes all of our safety numbers, everything like that. So barring something crazy happening, we're going to get that money. We pay off $45,000 of the principal of mortgage. That just happens. That's just the way it is when you have a mortgage. It's great. I love it. So then we did reverse math. What do we need to lose on this property? Like, we're bringing investors in. We don't ever want to lose money for an investor. I can be okay maybe not producing the same returns, but I will never want to lose their money. So we reverse engineered it. And so we would have to sell this property because we've made $75,000 in income coming in. We'd have to sell this property for about $400,000 in 5 years. So we looked at it and went, does this number scare you or reassure you? And Steve and I looked at each other and said, man, if there's a house in Victoria in 5 years from now worth $400,000, we're going to want to buy 100,000 of them. So that number didn't scare us. It actually reassured us, like, hey, you know what? It's going to be very hard for us to lose money on these deals. And so that's how we started making our calculated risks. So then we started, asking that question: do you feel comfortable in the risk versus reward, knowing the upside of this property versus the risk? Upside being that, it goes to $500,000 or $600,000 in the 5 years, which is what we kind of predicted. Or the risk being the economy turns and we spend 5 years on something that just completely breaks even at the end of the day. Well, that risk isn't that scary to me. It's just time. It made it a lot easier to make that decision. And then the upside was really big. We were making $100,000 to $150,000 on those properties, plus the mortgage pay down, plus the other stuff. That seems pretty good to us. So when we started looking at the risk side of it, it kind of just made sense. And that's what allowed us to make quick decisions and move forward with it.
The one thing I want to add in there real quick is just that we had the expectation and the understanding with our partners that this is going to be a long-term hold. Now, if you, like, for example, if you're comparing this to a flip, it's not a long-term hold. Anything can happen in a short period of time. Take COVID, for example, right? So if you're flipping back, March 12th or whatever, you might be in a little bit of hot water. But because this is a buy and hold strategy, we have less of that fluctuation in risk, because historically, real estate always goes up over time.
And I think when we did the math, like, Victoria in a 10-year span had not had a declining number if you average it over the 10 years.
Exactly.
So when you start looking at economics like that, like, wow, it kind of makes sense.
You hold it for 10 years, you made money.
And then our newest niche, it's the exact same formula. So Steve and I have now been playing in a different town called Duncan. It's just about an hour north of Victoria. And we're doing single family homes with suite. Everyone is telling us a year ago, we're overpaying for houses. This town doesn't appreciate, blah, blah, blah. It's the same thing we heard. And we just laughed. We were like, this is it. We're back on top of something before the market gets here. So it's the same math, just different area. Trusting our numbers and the facts, not listening to what people say. We're buying houses for about $460,000. And we're putting about $100,000 renovations into them, and they're renting for about $3,600. This is proven. We've done about 5 of them now. It's the same numbers across the board. As long as we're into something for about $550,000 is the point of this. It can be fully turnkey. It can be $460,000 with something. It just depends. Times it by the 0.063. That number comes out, hey, we're under our 3,600. We're good. Like, that's a green light for us. It means do your diligence. But for us, that means like, hey, if this property checks out, we're going to buy it. We're so confident in that number now. Now that number varies. Don't get me wrong. That number varies at 0.063 or that 0.63% varies with interest rates, and it varies with taxes, and it varies with a lot of stuff. But because we have and collect so much data for the properties we're doing, we're constantly analyzing that number in the towns that we go to. So we know in Duncan, although the taxes are a bit more, the numbers still formulate the exact same.
Yeah, that 0.63 rule is basically just like an indicator. It's kind of like that thumbs up, like, is it level or is it close to level, right? And so it's something that we use, like, even if the number, if we needed to hit 3,600 and, it's showing 3,500, that just gives us the opportunity to be like, hey, how can I create an extra $100 a month? Maybe it's adding storage. Maybe it's, getting paid parking. Maybe it's coin operated laundry. Maybe it's I can add a bathroom or a bedroom or something like that. It forces you to get creative and look at the opportunity of how can I get a little bit more, squeeze a little bit more juice out of these opportunities.
So this is exactly what Steve and I just bought in Duncan that we're closing on this next week. It's a house that we're adding a suite into, and it actually has 3 units. It's going to be a triplex. It's got a 2-bedroom main house, 1-bedroom executive rental, and then a 2-bedroom suite down below. The numbers are phenomenal, and it's going to be great. And we're just going to do them over and over and over again. Again, all with JVs. That's what we do. This is our gravy. So we know the math. We can make quick decisions, and it's a formula that just operates. So first thing on that, we can make quick decisions. This property that we're looking at that we just got under contract, again, it's so funny when we talk about these things. Like, this property is on the market for, I think, 20 days. So it was on the market for 20 days. The reason why nobody wanted it, they're subdividing the house and putting she's subdividing the lot and putting her house on the front, but leaving the remaining 2/3 of the lot to sell. Nobody wanted it because they didn't want to watch a building being built in front. It's a rental for us. By the time we go to sell it, it'll be a fence and trees, and you'll never even know it'll be a panhandled lot. Nobody wanted that. We saw it. So it allows us to make quick decisions because the formula works. And then our process is no different than development or apartments. It's just higher risk with higher rewards. You just get bigger onto the spectrum, right? Our risk becomes a lot higher in development, but our reward becomes a lot higher. But we still ask that same question. What would we have to liquidate this portfolio for, or this land for, in order to break even and get all of our money back to our investors? Then we make that educated decision of, hey, are we confident in that number? Yes. Cool. Then what's going to stop us from doing that deal? And that's how we start working backwards from this. So just ask yourself, what are the economics? What are the risks? What's your exit strategy? And what are the rewards? We have exit strategies on all of our properties. Try and go for 3. Can we flip it? Can we rent it? Can we go long term? Can we do rent to own on it? Can we do a bunch of different stuff on it? There's some cool options there. But we didn't go through this alone. We leaned on our network, and that was one of the biggest things. Meetups like this really helped Steve and I. Although we created this meetup and facilitate it, Steve and I are not the most experienced real estate investors in the room. I can tell you that. And what it did was give us the confidence that when we started talking about these numbers to more and more people, it became real. It became supportive. We had some good mentors, but we had people like Kyle Green in our corner saying, hey, yeah, the numbers look good. Let's do it. So that's something that we're super excited about. And we're really excited to tell you about this next opportunity on this next slide. Steve and I are still always trying to level up our game. As you guys know, Steve and I have invested heavily in our self-development, in our education. We're part of a bunch of masterminds. I think Steve and I have spent over $100,000 just on education and training. but we haven't been able to find something that we've been looking for the past year. So that is this. If as entrepreneurs, if we can't find it, we create it. So we are creating Synergy Mastermind. And I think Darren Voros is on this call somewhere. Steve and I strongly have been like, so we met Darren a little while ago and we started hopping on a call with Darren weekly. And we just started chatting about the deals we're going on. Darren's doing a big deal right now in Toronto. We're going through this property we are. And we just bounced ideas back and forth around the deal. How do you negotiate it? How do you do this? If we're going to be adding a suite, what should we do? How are you doing the zoning? And we just thought, wow, this needs to be shared to more people. So we just created this high-end mastermind, which is going to be for people who have done probably more than 3 deals in real estate, but really to help collaborate, expand, and grow. And so that's our tagline there: collaborate, educate, scale. It is going to be super fun. Steve, Darren, and I have been chatting and working hard on this on the back end for probably the past month and a half around creating this.
Been even longer than that. We wanted to launch this earlier this year. This has been in the works for almost a whole year.
Totally. So, Darren, are you on here still? Can you unmute yourself? I don't know if I can find you.
Yeah, I'm here. Hey.
There he is. So everyone, this is Darren Voros. If you haven't met him yet, he runs co-runs a group called Level Up Real Estate Investing, and they do meetups once a month as well. He has an incredible YouTube channel, very well experienced guy, very knowledgeable. Used to work for Keyspire, for those of you that are in here doing some speaking for them. And we couldn't be happier to partner with somebody of his ability. We just instantly had a good connection on wanting to collaborate, having the abundance mindset of wanting to work together and just create something that everyone could be a part of. And Darren, is there anything you want to say quickly about the mastermind?
Mostly just about how excited I am for this, sort of small, intimate group setting that we can really come together, virtually for the most part, but then also a couple times a year in person and learn from each other. Over the last couple of months, my biggest takeaway has been to just connect with as many people as I possibly can. And that has really allowed me to build my business over the last 3 months. And I've done more in the last 3 months than I've probably done in the last 3 years. And that's all with just connecting with like-minded individuals and, guys like yourself that I'm saying, hey, I've got a question about your systems or your automation or your accounting or whatever that is. And just having those answers, that's 2 people. Imagine 30 people of the same caliber. And I think that's why I'm so excited about this mastermind and what we are, and the people that we're bringing in as well, which are just the top of the elite, if you will, for speakers and people in the industry that are just out there killing it right now. And I couldn't be more proud of what we've created as a team, and I'm so excited to share this with everybody.
Yeah, we're super excited. If you guys want more details on it, there's the website there. You can look it up. But basically, we're taking 15 people from Eastern, like let's say Ontario kind of side, and then 15 people from West, being BC and Alberta, collaborating together to just create some incredible stuff, which is the interaction or cooperation of a group of real estate investors to produce a combined result greater than the sum of their individual actions. And great example is Darren introduced us to Monday.com. If you guys aren't using it, reach out to us. We're happy to show it to you. It is everything that we've been looking for. It's a, I don't even know what you call it, a task scheduler and so much more, but it's absolutely incredible. We wouldn't have known about that had we not been chatting with Darren. So
great project management tool.
So thank you guys for listening to that. If you are interested, hit it up. Steve.
And without further ado, I know I saw your sexy face on here earlier, Kyle. Unmute yourself, get ready to rock and roll. For anybody who, I'm sure most of you already know who Kyle is, but rewind a few years. Kyle really took us under his wing when we started up this meetup 4 years ago. He's been a sponsor of ours from day one. And one of the biggest reasons why we wanted Kyle and Kyle alone to be our partner was the fact that he is so experienced in investing. And I'm sure we've all kind of like beaten our heads up against the wall talking to a broker or a realtor or somebody else who's a professional that doesn't really fully understand the investing game. And it's just trying to fit a square through a round hole, right? And it just doesn't quite work. This guy here, he's so intelligent with it. He gets it. He works with his clients to just really create an awesome game plan so that you're taking the right steps for whatever your goals are, whether it's 1 or 2 properties or whether it's like us, we want 100. Like he helps you create that whole system. He's got a great team in Vancouver. He works with people from all over. And if you're just getting started, or if you've already done, those 100 deals, he's still got the capability and the expertise to really work with you well. So Kyle, why don't you hop in, say hey, and take it over.
Awesome. Thanks so much, guys. Cool. Let me share my screen and we will get rocking here. All right, cool. So presentation today, we're going to be talking about the coronavirus and the impact on real estate and you. I'm going to start to rewind and start to go back to what happened in March so we can talk a little bit about what happened, how it was impacting people, and now that we're through, at least through a few months of it, what we're starting to see, and then projections moving forward. So let's go through this. First of all, let's go through a bit of an overview of what I'll be talking about. So the impact on financial markets, as that's relevant for some of you, the impact on mortgages, the impact on real estate, some of the banking aid that's available, some of the government aid that's available, and some personal and business financing action steps, just to talk about what you should be doing and what steps you can be taking to protect yourself during this uncertain time. So first of all, financial markets. This is why we don't invest in stocks, right, guys? This was going back to obviously a snapshot in March. Values went from 17,000 in the S&P down to 12,000 in just a couple of weeks. So it's definitely a very, very crazy time. This is one of the reasons that we invest in real estate and not stocks. Obviously, there's a huge impact on stock markets. But look here, actually, this is highlighting the yellow bar is just one of them. There's actually a second bar here, or a second date as well, March 12th. So this March had the two of the 10 largest single day drops in the Dow Jones of all time. Major impact on stocks. Obviously, coronavirus is real. One of the things too that, and I'm not going to go too much into this, but for anybody who's interested in stocks, this is something that's kind of interesting, and it's really confusing as to what's happening right now. And we saw stock markets drop considerably, and now we see quite a rally coming up. But one of the things that's really important to note too is that if you look at this chart, for instance, is showing the 1929 crash, the 2000 crash, the 2008 crash, and the 2020 crash. Of course, there's not a lot of data here yet, but there were a lot of false rallies, they're called. So that means that essentially the market starts to pick up and then all of a sudden cracks again and picks up and cracks again. And so if you look at it here, there's been a lot of points where they're expecting that, yes, there's been a bit of a rally over the last few months, but that may not continue. So just something to be careful about or wary about in investing in stocks. I have had a lot of clients asking me about, should I be investing in stocks? Is this an opportunity? It's just something to be careful about, that I still think that there might be some worse yet to come that we haven't seen yet. I'm going to get into the meat of what I'm really talking about here, though. It's not about stocks. It's about mortgages and the impact on the real estate market. So this is the original impact of what happened to interest rates. They dropped quite a bit. Interest rates dropped from, and this is a bond yield chart, by the way. So fixed rates are heavily correlated with bonds. And in the immediate term, so over just that month period here, interest rates actually dropped from about, or bond rates dropped from about 1.4 down to about 0.6 over a very short period of time. And that's quite a substantial drop. Typically, when you see a drop of 1.4 down to 0.6, usually fixed rates fall roughly in tune with that. So there's a 0.8% drop in bond rates, which were immediately impacting fixed rate mortgages. So initially what happened is bonds dropped quite substantially. And normally this would mean that interest rates would go down, and they did for a very short period of time. So interest rates went down, but then all of a sudden banks realized, hey, wait a second, we might be lending cheap money to people that might not be able to make their first payment. And all of a sudden, it became harder for lenders to bundle up mortgages and sell them. And so all of a sudden, the spread over top of these bonds jumped up. And so we actually see fixed rates in early March go down, and then all of a sudden, boom, they went back up, and they actually had rebounded and actually cleared that gap to make them about the same. And one of the challenges is that the cost of securitizing loans had increased a little bit. So the cost of finding buyers for mortgage-backed securities actually increased. And that was a bit of a challenge and a bit of a weird situation where, hey, wait a second, bond rates are dropping, why are fixed rates all of a sudden going up? And we'll get to what's happening with fixed rates now in a couple of slides, by the way. And another thing that happened back in March and in April is the prime rate, which is set by the banks, dropped substantially. So the Bank of Canada dropped 0.5% 3 consecutive times. And so we saw a massive drop in the prime rate. Prime rate went from 3.95 down to 2.45. One thing that's interesting to note here is there has been precedence in the past for, although the Bank of Canada is dropping the interest rate, sometimes the banks don't fall in step with that. Sometimes even if the Bank of Canada drops 0.5%, sometimes the banks only drop their prime rate by maybe 0.25% instead. In this case, which was kind of interesting, the banks actually fell in tune. However, something called the CDOR rate decreased and then increased. And essentially what that means is that the discount off of prime, we used to be able to get, if it was an insured mortgage, prime -1, and if it's an uninsured mortgage, about prime -0.6 or 0.7 if it was owner occupied back in March. I remember clearly one day, it was March 13th, Friday afternoon, about 3 o'clock or 4 o'clock. And one of our major banks all of a sudden messaged us and said, hey, by the way, our rates are going from prime -0.65 to prime tonight at 9 p.m. It was crazy. So all of a sudden, we had to send off all of the deals that we had in the queue to that lender. But not only that, we now had to go through and find any other clients that may want to take advantage of the prime rate discount disappearing, essentially. I remember this back in the subprime crisis too, where what the banks did is they got rid of the discounting off of prime. And in fact, in the subprime crisis, it was even worse. It was prime plus 0.8 for about 6 months or 8 months. And that preceded the Bank of Canada dropping the interest rates aggressively, because the banks don't want to give you a really heavy discount off of a prime rate that's really low. So I remember that Saturday, that Sunday, Monday, Tuesday, and Wednesday, I think was the last day we had to send off to the last lender that changed their interest rates. But everybody, like dominoes, all of them went to prime on their mortgage rates. We were able to secure about 25 clients of ours, prime minus anywhere from 0.6 to 0.9% variable rates. And now those rates are looking really, really good, at 1.55 to 1.85%. So it was a really good opportunity, but it was very short-lived. And that opportunity, things like that only come up once in a lifetime, or once every decade, it seems.
Hey, Kyle, quick question.
Yeah.
Back of the napkin numbers, you taking that action to get your clients that result, how much money do you think you saved everybody?
I had a couple of situations where clients were paying 10 grand to break their mortgage and saving $35,000 estimated. Yeah, it's an insane number. It's a crazy, crazy, insane number. So that's definitely something that comes up. And obviously the spread is much larger in a larger mortgage, right? So $1 million mortgage, somebody's going to save a lot more money than somebody on a $100,000 mortgage. But some of our clients, the math was heavily in their favor. And in fact, when this first happened, the prime rate had only dropped 0.5% when the rates all of a sudden went from prime minus 0.65 to prime. And so I was telling a lot of our clients, look, I don't have time to go over, all of these different things. I just need to know if you're interested or not, because I need to spend 5 minutes with you. I need to send off your deal to the lender. And then if the prime rate keeps decreasing, you're going to be really, really happy that you said yes, And I think we had 1 or 2 clients that said, you know what, thanks, Kyle. We decided that we just don't want to take the risk of going into a variable rate. We're just not sure. And that's totally fine. But we just didn't have time to have long, in-depth discussions, because in 5 business days, we had to get as many deals out the door as possible. It was crazy. It was a really crazy time. And again, on variable rates, the cost of securitizing loans had slightly increased. And so again, those discounts had eroded. One of the easiest ways to know where variable rate discounts are heading is to look at what's called the VIX, which is basically a volatility index. And so you can see that this volatility index that spiked in March, it's now lower. It's about 20. I think that the number is more like 24 points or so. But the volatility index had spiked back in March. And this is usually a pretty good indicator of what's happening in variable rates. unlike fixed rates, there are a lot more indicators and a lot more factors being involved. So it's hard to pick one indicator and say this is what's going to happen with interest rates. But this is the easiest way. So anybody who ever wants to predict what's happening with the variable rate discounts, this is the way to track it. So one of the things that come up here is where our rates are heading, and this is my explanation of where rates are heading. At least, and again, this is back in March. So, like, where are rates heading? Let me put up this chart, and then let me do all the graphs and predictions and whatnot. Nobody really knew at the time. I think that now we do have a bit of a better idea of what's happening with interest rates, and so. For instance, it sounds like the Bank of Canada is predicting that interest rates will stay at record lows until 2023. So if you're going into a variable rate or considering going into a variable rate, it sounds like you probably are going to enjoy 2.5+ years of being at the same rate that you're at right now. So that's something to consider. The rates right now are quite low. You're looking at about, on a variable rate with the discounts that are now being offered, about 1.9 to 2.4. So the discounts have slowly come back into the marketplace. Instead of offering prime, or for a while they're prime plus 0.2, now they've dipped back down, and now the variable rate discounts are a little bit more attractive. And so on an insured mortgage, we're getting as low as about 1.9. On an owner occupied, we're somewhere between 2 and 2.1. And for rentals, they can be as high as 2.4. Just depends on which lender we have to use. Fixed rates. So now the Canadian bond yields are about 0.4%. And the good news here is that the spread over bonds has decreased to more normal levels. And so instead of the spread increasing up to about 2.3% in general, you can usually bank on a fixed rate mortgage being about bond yields plus 1.5 to 1.8%. That's the typical spread. And so if bonds are right now 0.4, then fixed rates should be somewhere between 1.9 and 2.2%. Generally speaking, an insured mortgage is going to be on the low end of the spectrum. Owner occupied is going to be the medium to higher end of the spectrum. And then rental property usually on the high end or slightly over that 1.8% spread. So right now for a fixed rate mortgage, an insured mortgage is getting 1.99%. A owner occupied is somewhere in between 2.19 to 2.44, depending on the amortization, if it can be insured or not. And then as high as 2.69% if you're getting a rental property. One of the things that we are recommending to most of our investors to go variable, one of the reasons for that is to ride the wave down, and we are getting closer to the bottom out point with fixed rates. And so there's not much of a wave to ride downwards anymore, but especially a few months ago, with the spread being so high in fixed rates, if you went into a variable rate and then waited, the expectation would be that you may be able to lock into a fixed rate at a later date, because you can lock in into a fixed rate at any point in time during the course of the mortgage. But here's the most important one, and this is a big one. The penalty to break a variable rate mortgage is 3 months interest. So to put this in perspective, I've been running some numbers on fixed rate mortgage penalties, and here's the part that really baffles a lot of people, and it's hard to understand why they would calculate it this way. But the way that a bank calculates a mortgage penalty is they take the current posted rate and then the discounted rate that you get. So right now, if you got a rate of, let's say 2.44%, the bank's posted rate might be 4.94%. And so they're giving you a discount off of their 5-year posted rate of 2.5%. Now, let's say that fast forward 2 years, you go to break your mortgage. What they do is they take their current 3-year posted rate. So that's the same term remaining on your mortgage because you're 2 years into your 5-year term. So you have 3 years left. They take the 3-year posted rate, and then they subtract 2.5% off of that to determine what rate they're going to use to calculate your differential penalty. The problem with this is that a 3-year posted rate might be 3.5%. And so they say, okay, we're going to take 2.5% off of that, which is the original discount you got off of your posted rate. And we're going to use a rate of 1% compared to what rate you have right now. And we're going to use that to calculate your differential penalty. Now, a bank isn't giving anybody a 1% interest rate on a 3-year term, but yet that's the rate they're using to calculate these differential penalties. And it's very unfair. What I'm finding in a nutshell is that the penalty cost to break a fixed rate mortgage, if you break it in a 1 to 3 year period of time, the penalty to break that mortgage is anywhere from 5 to 10 times more expensive than if you were in a variable rate mortgage. So it's interesting because a lot of the time we think, A fixed rate mortgage is actually the insurance policy. It's, hey, take this mortgage and now you don't have to worry about where interest rates head in the next couple of years. But the question is, well, what if you decide for some reason that you have to sell? And trust me, sometimes it's not a matter of deciding. Sometimes people break up and have a divorce. Sometimes something happens in a life situation and you need to get that equity out of the property. Maybe you're an investor and you bought it with one bank and now you want to refinance it. And maybe that bank changed policies and you don't qualify with that lender anymore because maybe you bought more properties and now you don't qualify. And now the only way to get access to that equity is to refinance it and move it to another lender. There's a lot of reasons that can trigger a mortgage penalty. And one interesting fact is that the average length of time a borrower has a mortgage in effect is 38 months. So 3 years and 2 months is the average length of time somebody has a mortgage in effect. So when you factor that in, it's really interesting to realize how massive these penalties can be. One of the things that I do recommend is for anybody that is going to go with a fixed rate mortgage, if you can get qualified with them, and they are tighter right now, especially on rental properties, but if you can get qualified with what we call a non-bank lender, then that's usually a way to mitigate that because the calculation on these penalties is much more fair. But I've run some numbers here, and some people's penalty, if they were in a variable rate mortgage, would be $4,000, $5,000, and the penalty if they were in a fixed rate mortgage and they broke it in 2 years would be like $45,000. It's insane. It's a huge difference. So something to keep in mind. The other obvious impact on financing and mortgages is the availability of money. So there's a lot of things that have changed in the last little while. Number one, it's important to understand some lenders are still going to allow you to close even if you've been laid off, and this is case by case. So for instance, some businesses or people that work in certain industries where they're expected to return to work in a very short period of time and the application is quite strong. This is something where the lender will consider it. Not to say that they will or won't, but they can consider it. One issue that we found is that they are tightening up on rentals and getting, especially if you have more than 5, it's a lot harder to get financing now. Not impossible, but a lot harder. One lender changed their policies where they're not allowing you to borrow your down payment for a rental property purchase, which means that if you want to borrow money from a home equity line of credit, that doesn't work. You have to show that you have cash. Now, of course, being the creative mortgage broker that I am, there are ways to get around this. But at the end of the day, it is harder to get financing if you're increasing your overall leverage in order to buy a rental property. Self-employed, man, have we ever had to sell self-employed deals? I had one recently where the lender didn't want to do the deal. What I ended up having to do is I went through the client's previous financials. I looked at his previous gross income and his current and his margins on that income between his gross income and his net income. And his margin was about 60%, I think it was. I looked through those expenses and figured out which ones were normal expenses for his business. Then I have to look at the last 3 months of bank statements during COVID, looked at what that number was, attached I think I bumped up the number a little bit to a 70% margin, expecting that some of his expenses he's cut back on, and explained that to the lender and said, if I take 70% of his current last 3 months of bank statements, his income would still debt service, and so you should still do the deal. And that still had to go through management. It took 3 weeks to get approved, an extra 3 weeks, I should say. So it is tougher if you're self-employed. You really have to sell it. If you're going to a broker, then you should be selling the broker so the broker can sell it to the bank. That's what we're telling our clients all the time is sell me so that I can sell the bank. Because if you just send it into the lender and don't explain how COVID has impacted your borrower and don't provide an upfront explanation, then you're really asking for you to get your to get shot in the foot. So really important to make sure you state your case. Max equity takeout. Some lenders are really cutting back on how much money they want people to be borrowing and taking out of their home. So that's something that's just getting a little bit harder. And in general, just a slight tightening across the board. There's a lot of little minor rules and nuances here that would take forever for me to go into, but it's just in general, they're just a little bit tighter for A lending. So let's talk about B lending. B lending would be alternative lending. So there has been a slight reduction in loan to values. So in general, if a lender used to do 80% financing, now they're doing 75. If they are charging higher rates, I am finding just recently over the last month or so, they're starting to come down. And I just got an approval with a B lender at 3.39% for a 1-year term with a 1% fee, which is actually pretty good for B lending. Not too long ago, probably about a month and a half ago, most of the B lenders were over 4%. So I'm starting to see that these quotes are getting more competitive now. And B lenders are a little bit more willing to work with incomes. And so there's a little bit more flexibility with B lenders. So they haven't really changed a whole lot, because at the end of the day, they're looking at bank statements to determine if you qualify there or not. If your bank statements have decreased significantly, then you're going to have a tough time getting qualified anywhere. But if you're still making money, you're going to have a little less questions and a little less of an issue getting financing through a B lender than an A lender. Private lenders, they cut back in a more substantial way. Most private lenders cut their loan to values back by between 5 to 10%. So a lot of the private lenders that used to do 80%, now they're doing 70 or 75. Some of them have cut down to 65. And during the heyday of COVID back in March and April, some lenders actually cut it down to 55% loan to value maximum. And those would be the very low risk type of mix and private lenders that would usually price deals at like 5.99% with a 1 or 2% fee. So pretty cheap money, but very cautious money. One of the things that was interesting is that redemptions out of a MIC was, a lot of those were freezing. What that means is that if you had money and you invested it into a MIC, the MICs actually were freezing redemptions, meaning that people couldn't redeem their money and pull it out of the MIC because they're concerned that they would have a run on the bank and then they would run out of money and wouldn't be able to keep all the loans that they have in effect. And so we saw some MICs say, hey, you know what, guys, sorry, we're not allowing people to take their money out right now.
What's a MIC, Kyle?
A MIC is a mortgage investment corporation.
Okay.
Yep. That's a group. So instead of a private lender being one person that lends to one borrower, instead a MIC is a group of investors. So if I want to invest in a MIC, I would buy shares in the MIC, and then the MIC lends money out to a number of different people. So it spreads your risk out amongst a number of different borrowers. The exit strategy is the most important thing. And we used to find that pre-COVID, one of the exit strategies could be, I'm going to sell the property. I'm going to flip it in a couple of months. When COVID hit, obviously selling became much more of a question mark. And so that wasn't good enough of an explanation as to why a lender should lend to you. And that's where we really had to make sure that we provided a really good plan A and plan B, AKA, yes, the client's intention is to flip this property or sell it. But if they don't, and they have to rent it out, here's how they're going to be able to afford those payments. And so private lending had tightened up a little bit, and we're starting to see that they've slowly come back a little bit, but they still haven't come back to pre-COVID levels.
Hey, two quick relevant questions here just in the chat. Eunice says, how is it to get a rental mortgage with having a break in employment, and then tagged along with that if you're using a refinance mortgage?
It's harder. Yeah, that's for sure. If you're not working right now, it makes it a lot harder for you to get funding for sure. In most cases, if you've been temporarily laid off, let's say that you're a dental hygienist and you were temporarily laid off, it's a lot easier to understand that, well, once you're back to work, you'll be working and you'll be full-time right away, because people are going to need their teeth cleaned, and that type of employment is going to come back to full strength. But there definitely have been a lot of employees who are laid off. They have no idea when they'll return to work. And in certain industries, there's just a lot more question marks revolving around that. And so we've definitely had some struggles with that. If you layer on top of that, trying to refinance to use the down payment, you're probably going to have a tough time qualifying for the refinance just to begin with if you're not working. So it's tough.
And refinance alone, even if you are working?
If you are working, then that's okay. Yeah.
Thanks.
Yep. Commercial loans. This is an area where commercial lending had tightened up quite substantially. I had a lot of what are called letters of interest, which is almost like a little bit more than a pre-approval, but it's basically a lender saying, yes, I'm interested in this deal. Here are the terms that we think we could do. Here's what information we're going to need. And if all this clears, then we'll issue a final approval. I had quite a few letters of interest heading into COVID, and then all of a sudden, either our clients were backing out because they're getting nervous, or the lenders are starting to move the goalposts. And frankly, in commercial lending, for those of you who have ever gone through commercial, the goalposts move quite a bit in commercial, a lot more than they do in residential. Residential is very black and white and very certain. Commercial, the goalposts move, and as soon as they get more information, then they move around a little bit. But during COVID, I found that the goalposts are moving a lot further than you would expect. I had a lot of really good deals where the lender said all of a sudden, yeah, we're going to need an extra 100 grand down payment, and we want to see if the client has an extra 200 grand in the bank. We're like, holy cow, like that's, you're moving the goalpost quite a bit on us. And so that had really changed and definitely made things a lot harder. Another area that really had changed, and this is not just with commercial lending, but the residential lending too, is timelines. And what's happening right now is it's a seller's market. And so every offer has to be competitive. And one way to make your offer competitive, other than price, is to have a shorter subject removal period. On the flip side, all of the lenders are swamped and super busy because there's a lot more work involved to underwrite a deal right now because there's a lot more questions. As I was talking about earlier, is this person employed or not? How might COVID be impacting their future employment? If you're self-employed, you've got to do way more explanation. There's way more exceptions that need to be made and a lot of internal policies that lenders have right now that they have to follow. So there's way more inefficiencies in the marketplace on the lending side, which is just slowing down timelines. And yet on the other side, in order to get an offer accepted, you have to have a short, timely subject removal. So things are getting really, really, really squeezed. Ivana had a question here about a commercial approval. So in general, timelines on a residential deal, usually 1 or 2 weeks is usually enough. I will say that some lenders are a little bit longer than that for a purchase, but most lenders, you can get it done within 1 or 2 weeks in residential. On the commercial side, usually I would say 4 to 6 weeks. Right now I'm saying 6 to 8 weeks is the safe bet to get a commercial deal done. We have still been able to get deals done in 4 weeks, but it's just a little bit harder. And it's obviously running the risk, a higher risk anyways, or higher chance of needing an extension on the subjects later on. So just keep that in mind. The timelines on commercial are much longer than they are in residential. And there's another question about CMHC. CMHC is extremely slow. Right now they're about 8 to 12 weeks on turnaround. It's incredible. So unfortunately, what's happening and what our recommendation is, if you're wanting to get CMHC insured financing, then try to get a really long closing date. And then between the purchase date and the subject removal, we'll get a conventional loan approved. And then after that, I should say concurrently, while we're getting the commercial or the conventional loan approved, we also submit it to CMHC, get it in play. And then that way we have the conventional loan approved so we can remove subjects on our worst case scenario. And we keep working on the CMHC financing before closing. So that's the ideal route to take. One thing to keep in mind with CMHC right now is that they're not doing refinances unless it was for capital improvements. And so if you close with a conventional loan and then go to refinance it with CMHC later just to drop the interest rate, CMHC will decline you. They'll say you're not doing capital improvements to the property, so we're not going to refinance you just so you can save money in interest. So it's very important to understand that it's not like the past where you could just close with conventional and then refinance with CMHC later. You actually need to show that you were doing capital improvements, and that's the purpose of the loan. So something to keep in mind there. So the impacts on real estate.
Can I interrupt you for 1 sec, Kyle? Back on the commercial side. What about amortizations? Because that's what got me when I was chatting with you about that potential deal, was that it was going to be a 20-year amortization. I don't know if that's normal or not, but that was a bit of a shocker for me that you said it's probably going to be closer to that.
Yeah, so conventional is 20 to 25 years typically. If you go CMHC, you can get up to 40 years, but it depends on the age of the building. So a brand new building, you can get up to 40 years, but CMHC does charge a premium for every 5 years over 25 years. So the impact on real estate. Here's the 2020 projection. So starting the year, most economists are predicting anywhere from a 3 to 6% gain especially in the BC market here. Then COVID hits, and there's a lot of question marks. And is this a house of cards or Jenga? The expectation was, and this was my interpretation, that there could be a 10 to 15% drop and then a rebound back. I would say that for about a month there, the values may have dropped up to this number, depending on the market and depending on where you were. But we've rebounded back quite strongly. It really depends on which market you're buying in. I'm going to get to appraisals because this is a really important piece of the puzzle here too, because if values have rebounded, then why are appraisals coming in low? But it's an interesting situation right now. Moving forward in projections, now a lot of economists and I was actually on a call today with Scotiabank's economist. A lot of them are saying, you know what, guys, we were wrong. We thought that values were going to drop because of COVID, but we didn't realize that the low supply as well as demand coming back fairly quickly would actually result in a market where prices are being, are leveling out. So it seems like right now prices have at least leveled out for the next little while. A few things that we're seeing. So let's talk about appraisals. So first of all, when you're doing an appraisal, you usually need to get an inspection of the interior of the unit. What appraisers are doing is they're going out, taking photos of the exterior, and then asking the occupant to take photos of the interior and then send them to them. That way they don't have to come into the property. Now, that being said, we're having some valuation concerns, especially on refinances, and the issue is lack of comparables. And so at the end of the day, here's how an appraiser looks at a property. They look at the property, and they look at 3 to 6 recent comparable properties that have sold in the last 3 months. The issue is, although prices are going up, it doesn't mean the market is showing a lot more sales, okay? So right now what we have is a low supply and a low demand. And the result of that is not a lot of sales, but multiple offers on the properties that are going. And that is keeping prices in check, but it's not resulting in a lot of sales happening over the last couple of months. And so when an appraiser appraises a property today, in July, they'll be looking back at sales that happened back in June, May, and April. And guess what? April was not a very good month. May was an okay month, and June started to pick up and was starting to improve. And so the issue here is there's not a lot of sales to pick from to support the valuation that you're looking for. Now, in general, on a purchase, usually we don't have as many issues. Although I am working on one right now where I do have an issue, and it is a property in Victoria. And the property had appraised for, I think, about $655 or $670 back in April. Because keep in mind, back in April, you can take comparables from February, March, and April, right? So that was some of the comparables were pre-COVID comparables. And now, though, we have to take comparables that have sold in the last 3 months, and there's way less comparable properties for this particular unit. And because it's a duplex, they just can't find any comparable sales that they can say, hey, this is a comparable property. So we're running into some issues on appraisals for sure. This is a concern and a challenge. But again, in general, on a purchase, usually we're finding that they find a way of getting up to the appraised value. But on a refinance, a lot of our refinance appraisals come in low based on the expectations of our clients.
What can you do? Is there anything you can do for the appraisers coming in? Can you provide a package? Can you, show your renovations? Can you do whatever? So what we're normally doing is buying them cash right now and then getting a mortgage put on them. But still the appraisals are coming back low because of the same thing. So is there something we can show them or packages we can put together or anything?
Yeah, at the end of the day, if we have an issue with the valuation, they're always going to ultimately say, show me some comparables that I can use, right? And so if you or your realtor have a package where you say, hey, hi appraiser, by the way, here's a package of 6 comparables that we think are fair comparables for you to consider when determining the value of our property, that will help. It also helps too, when I had this issue happen a couple of months ago, where I had a client that did extensive renovations, like 150 grand to their house. But the problem is when they took their photos sucked. Like their photos were super blurry and fuzzy. And so because the appraiser couldn't get into the unit to actually see how nice the property is after the renovations, my client's photos were not very good. They're not a photographer, and frankly, the photo quality was not very good. And so even when I'm looking, I'm like, you paid 150 grand for this kitchen? Like, I don't see it, right? So the photos weren't really doing it justice. That's where we had the client go back and say, hey, here's what I spent on it. This is what I did. Here's my budget, et cetera. And that helped a little bit. The appraiser did come up a little bit on the valuation, not as much as we hoped, but that's a way of dealing with it. But ultimately, comparables are the number one way. Number two is, and it shouldn't make a huge difference to the appraisers because they're usually pretty good about looking at the objective things, not subjective things. But just, clean up your house a little bit. If you're a hoarder, then, rent one of those bins and throw your stuff out, So that's something to consider too. Viewing homes, obviously this became harder. One thing that we found is that it was a lot easier to view homes that were vacant and a lot easier for investors to buy properties that were vacant. one of the things we found was that 3D tours done by a realtor helped a lot, so that you could see and visualize the home without having to go see it. Because a lot of, for a while there, sellers were not willing to show homes in certain cases, except to very, very like buyers that were very, very anxious to write an offer on it. And so we did find some clients in the heat of COVID were writing offers subject to viewing, which is kind of a different way of doing it. Usually you go view the home and then you write the offer, but we did find that reversed a little bit. And another thing that we saw is that lawyers, for a period of time, they were considered an essential service, but for a while there was a bit of an issue where banks required people to sign in the presence of a notary or a lawyer in order to get a mortgage. But after about a month or a month and a half, the banks finally allowed lawyers to do this over Zoom, for instance. And so you can actually sign your legal documents over Zoom if that was required or requested by you. And so there are now some ways that you can get around that. Actually, you know what? I have one other thing I'm going to bring up here, because this is kind of going back to lawyers and closing on homes and having tenants in the property. I had a couple of issues came up not too long ago, which was a seller actually sold the property and provided the notice to vacate. The tenant signed it and everything. And then when you got to closing, the purchasers go to move in, and the sellers say, or the tenant actually says, you know what? Actually, Trudeau said that I don't have to move out of the property, so I'm not going to move out of it. And it caused a lot of issues and concerns. And so going back to, viewing homes and trying to position your home for sale, having a tenant in your property is a detriment, or can be considered a detriment. And it's a very hard legal situation to deal with, because the seller fulfilled their obligations. The buyers fulfilled their obligations too. So it was kind of a weird situation that came up. A couple of things that I want to talk about, which was the banking aid that's available. Payment deferrals, they're allowing you to defer up to 6 months. The payments are being added to your outstanding balance. There's no negative impact on your credit, but note they are making a note on your credit to say that this person is deferring their payments. And one thing to keep in mind is there's still a skip a payment option. So lenders allow, without you having to go through the deferral, you could skip a payment without having to qualify or go through any process to do that. A lot of banks allow you to just go log in and click skip a payment. Now, on the payment deferrals concern or issue here, banks will not finance you if you are still on a payment deferral program. So they're not going to let you buy a new rental property if you're deferring payments on some of your other debt. It's very important to note that. So we've had a couple of clients who were deferring their payments, and now we've got to qualify them for a purchase. And the bank says, well, that's fine, but you now need to get off the deferral payment plan. The reason for this, depending on the lender, if you're deferring your payments, your balance is going up. When they're going to determine what your new payments are after you've been deferring it, some lenders are going to push the amortization out, and some of them will keep the amortization the same, which means that the payments need to go up. And so the bank wants to see what is your new payment on your your current mortgage. If you've been adding to the balance and you're still in the same amortization, that means that your payments are going to go up. So that's something to consider. So if you're on a payment deferral plan, and you want to buy something, you should get off of it. Obviously, on the financing side, ways of the banking aid, we were telling a lot of our clients refinance, and this is still something that we were telling our clients. If you're thinking that you might need to get access to capital, you should do it before you actually need it, especially with uncertainty in the marketplace and concern about perhaps a second wave. If you're in a bind and you lost your job and you can't get a mortgage through a bank, but you really need cash, you can still get a second mortgage. The pricing is not cheap, but what you can do is apply the Band-Aid, make sure you don't have to go into credit, and make sure that you don't have any issues with your credit. So then once you do have a job again, you can refinance and bundle in your first and second mortgage into a first mortgage again. Personal loans, there's still options on the personal loan side. And a very cool thing is through BDC, so Business Development Canada, that's a Crown Corporation. We're able to point a number of our clients there to get up to $100,000 secured through their business. Does not show up on their credit bureau. It was a purely online application, and they did not ask for a single document. You filled out a form online. Yeah, $100,000 at, you know what rate? 2.8%. 2.8%.
We don't need you anymore, Kyle.
Yeah, I was gonna say, look me up, bro.
Yeah, I know, right? Yeah. Seriously though, anybody who hasn't gone through this already, send me a note and I'll send you the link for it. If you own a business and you have to meet certain criteria, But if you own a business, borrowing money at 2.8% is pretty good. Now, keep in mind, the amortization for this loan is quite short. So the first 6 months are interest only, and then it's a 5-year term. And so the payments are a bit higher than like a mortgage payment. But hey, if you're in a situation, so as an example, we had clients that had a bunch of unsecured debt and they were self-employed and they wanted to qualify for a mortgage. So guess what we did? Go get a BDC loan, use that 100 grand to pay off all of your debt. And because that loan doesn't show up in your personal credit bureau, we just wiped out a bunch of debt off of your credit bureau, and now your debt servicing levels drastically got much better. So this is a cool little trick that we are using to improve borrowers. Government aid, there's been a lot of stuff. I'm not going to go through this for too long, but I'll quickly highlight this. They increased the child tax benefit, gave people more time to get their taxes done and more time to pay. The applications for EI and whatnot, they changed that around a little bit. The Canada Emergency Response Benefit and student loan payments, they actually had stopped for a period of time there. If you're self-employed, there's quite a few things here. The most important ones, the 75% wage subsidy with businesses that had a 30% drop in revenues, and there's a lot of criteria. They actually just changed that around a little bit too. I was actually looking at it today, and then I got distracted with some client stuff. But they've changed that a little bit, and so now the criteria has opened up to more people. So in fact, I'm looking at do I have any months where month to month? So was my April this year lower than April last year? Was my May lower than last May? Was my June lower than last June? Because if it was down 30%, I might be able to claim a subsidy, even though my last quarter two, my numbers are probably much better than last year. Maybe there was 1 month where I was actually 30% down, and maybe I can claim a subsidy, right? So lots of things to look at. Work sharing programs. They have a big work sharing program, which I won't get into. This one's great. The business credit, there's a $40,000 loan, and if you repay it by December 31st of 2022, 10 grand is forgiven, and it's interest free. So why wouldn't you take it, right? Literally. And then I already talked about the BDC loan of 100 grand. Okay, this is really funny. So they talked about how, hey, these are some things for tenants and landlords, and I read it. I'm like, where are the positive things for landlords in here? I don't see anything that's positive for landlords at all. So the only thing really that helped a little bit was there's a temporary rent supplement. So if the person couldn't afford the rent at all, then the landlord could receive directly from the government $500 a month. Woo, awesome, great. One thing that really had a negative impact was halting evictions. So now even if you had a crappy tenant in one of your properties, you couldn't get rid of them. And that example I brought up earlier about the situations where a seller selling a property and couldn't get rid of a tenant caused some grief for sure. And also freezing rent increases. So I don't see a lot of benefits for landlords here, but it's kind of funny going on the website and they said, hey, these are some of the improvements and things that are going to help landlords and tenants. I'm like, I don't see very many things for landlords here. Just a couple of things on the personal and business financing action steps. So just some things that you should be looking at doing is cutting non-essential expenses. So as soon as COVID hit, the first thing I did what I needed to do to increase my revenue. And that was when I went through my database and we found about 25 clients where we could refinance and create win-wins. So our clients were saving a bunch of money. And of course, it was creating some extra revenue for myself and my team so that I could hold on to all of my staff during an uncertain time. Then the very next thing I did though, is I started going through 3 months of my credit card statements and bank account statements to look at what expenses should I really be cutting here? You know, is there anything that I shouldn't have here? And you'd be surprised. Sometimes I go through this like, do I need 7 Adobe licenses in my office? Can we cut that back? You know, that's $17 a month per license and little things like that. And you start to cut back and you really should, you know, it's a good moment and a good time to go through this. I will say this too, as we went through to some of our suppliers for some of our technology, et cetera, we said, hey, you know, we're looking at cutting this service. All of them said, hey, you know what? No, don't cut us off. We'll give you 3 months for free. Sure. Okay, I'll take 3 months for free, right? So it was a very interesting and essential experience to go through that. Cut your non-essential items. And one of the things that's important too, guys, is be fast and be ruthless. Don't be behind the curve. Don't cut the expenses when it's too late. You got to cut them now, especially if you're not sure if you're going to be able to make it through. The other things is to be finding opportunities. So be greedy when others are fearful. I always like to say that in moments of big swings and big change in the industry, it's the people that find a way of adapting the best that are cut above everybody else. So find a way of adapting to the change better than everybody else, and you'll find yourself ahead of the curve. There's always opportunities hidden, and it's also a good time to reflect and plan on, how do you move forward. Quick summary here that I'm going to talk about. Number one, interest rates will stay low for an extended period of time. There doesn't seem to be any indication whatsoever that interest rates are going to be going up in the next little while. Variable rates looks like it's probably 2.5 years plus, perhaps, before interest rates start to go up. For fixed rates, harder to predict exactly, but I think that rates short term will go down a little bit further, and eventually at some point, I don't know exactly when, but eventually they will start to go up. By the way, that's a really good opportunity. As soon as rates hit that bottom point and they start going up, that's a great time to refinance, because what will happen is you're going to have a low rate held here. And if rates keep climbing up and you have a renewal in about a year from now, if I have you a rate held at, let's say, 2% and the rates climb up to 2.5%, that 0.5% spread over a 5-year term on, let's say, a $500,000 mortgage, that's a lot of money you could be saving. That's $2,500 a year. So $12,500 you could be potentially saving by being able to do that. And it may mean that in some cases it makes sense to break your mortgage early, pay the penalty to take advantage of a low interest rate. So be prepared. One thing I talked about earlier is timelines are getting squeezed. Be pre-approved. Don't come to the mortgage broker or banker and say, hey, I wrote an offer. I have 3 days to remove subjects and expect the deal to get done. Timelines are really tight right now. I still think that low supply will keep prices in check. I don't see the supply drastically increasing, and the demand seems to be quite strong still. So I think low supply will keep prices in check. That being said, I am still cautiously optimistic. I think that it's possible that Q4 might start to show some cracks. I'm not sure if the government subsidies will continue or if they're going to start to pull back at that point. This is where a lot of the subsidies will start to end based off of our current timelines. There's also when payment deferrals will end. And just in general, a lot of people will hold on for a certain period of time by dipping into their credit, but eventually things will start to get worse for some people. On the flip side, though, I do feel like in Vancouver and BC in general, we're doing a pretty good job of keeping COVID under control. So I'm cautiously optimistic, but I still think that as a business owner or just as an investor, it would be prudent of you to stay liquid. So make sure that you have a nice liquid padding just in case things do start to get a little bit worse, starting maybe in Q4. I think we will have a strong showing through Q3, though. I think that Q3 will be quite robust still. Action steps. One thing to look into is see if it makes sense to refinance. We've been doing a lot of numbers for people. In some cases, it makes financial sense to refinance. In some cases, it doesn't not, but it's definitely worth looking into. If you need money, get it now. Don't wait. If you think that there might be any change with your income or anything like that, it's important for you to look into this. There is the uncertainty of perhaps a second wave. And so if you're thinking that you might need money, you're better off to get it before you need it. If you have pre-sale closing this year or next year, you might want to look into getting an approval now. Lenders can do rate holds and approvals. Many lenders can do it for 2 years. And so if you close in the next 2 years and you haven't done that yet, then it's something you should probably look into. And another item is to look into government grants like the BDC loan that I talked about earlier. So if you need any help with numbers, let us crunch the numbers. Yeah, I can see some nodding with your on this slide. At the end of the day, I'll open up for, if I have a few minutes, guys, I'll open up for some questions, and that's it. That's all I wanted to talk about.
Awesome, man. That was epic. Virtual round of applause for this dude. You always over-deliver on your presentation, so we thank you for just being consistently amazing.
Yeah, no worries, man.
We did have a few questions. Oh,
yeah, go ahead, Steve.
I was just going to say we had a few questions. I have them listed here. Kyle, I'm going to take over your share screen here for a sec. This guy here. And so the first one is more so about the 100K. So
of course, I knew you guys would be asking about that one.
Right?
100 grand, all right.
Can a numbered company go for that?
It depends. So it has to be a company that conducts business. A numbered company, like a holding company, that's not their intention. So to understand what the BDC is all about, in general, when you're obtaining funding through the BDC, it's from their perspective a way of growing and spurring the economy. They're not going to lend money to somebody who's running an investment business to buy more investments. Okay. However, I got 100 grand through the BDC so that I could use that to close on a rental property, but I applied through Green Mortgage and then funneled the money into my holding company, right? So you can still get money through that source, but you have to have an operating business that has a reason to be borrowing the money.
Gotcha. Kind of rewinding back to, I guess, some qualifying and stuff here, and looking into the future. Like, are banks currently looking at that ability to debt service all that stuff that's been built up over their 6 months if things open up again in Q4?
Debt service, you mean like the deferrals and whatnot, or?
Yeah, and how people can qualify for that after that. And
yeah, that's the thing. The banks don't want to finance somebody unless they're off the deferral plans, so they know what are your new payments based off of that, right? So at the end of the day, some banks, the way they're going to calculate this is that your payments will rise. It might be $100 or $200 a month. It's probably not going to be a substantial increase. For instance, per 10 grand on a mortgage, the cost is about $40 or $45 a month. So your payments wouldn't increase significantly. But if you deferred 6 payments and the cost was about 10 grand, then you could expect your payments to go up by about $40 a month.
Okay. We had a question real early in the chat. Kevin, I did not forget about you. I did copy it down. It was just a little off topic, but it's a really great question. It's about VTBs, vendor takebacks. So from your side of things, how can you just explain what a VTB is? How does it work if you're involved? And the question here is if they can be used through MLS purchases and best ways to approach a seller about them.
Yeah, so a VTB is a vendor take-back mortgage. It's basically where the seller is offering the mortgage to the buyer. VTBs are still doable, but I will say this, that often the idea behind it was that you would go to the bank and get a mortgage of 80% of the property value, and then you would ask the vendor for 10%, and then you would do a down payment of 10%. So that way you're funding 100%, but you're only coming up with, let's say, 10% down. And we used to, in the past, and I'm talking like 7 to 10 years ago, we used to be able to do that on a consistent basis. The issue now is that the banks on a rental property mortgage, let's put it this way, if they're not allowing you to borrow money from your own HELOC, they're definitely not going to let you borrow money from some seller issuing a vendor take back, right? So that's definitely tightened up. I still sometimes see it where you might be able to pull it off on a owner occupied, although it's very rare. But you might be able to pull it off on an owner-occupied purchase where you might be able to get a bit of a vendor take-back because banks sometimes will allow a second behind them. But most banks nowadays do not allow second mortgages behind them, and so it's very challenging. The only places that I see this more common would be commercial lending, where sometimes a commercial lender will do that, especially on a repositioning loan where you get the vendor to take back some of the debt in order to be able to come up with enough cash to do it. Or if you just do the entire thing with a vendor take back mortgage. So you put 20% down, the vendor carries 80% mortgage back. And then maybe in a year or two, you have like a 1 or 2 year term, and then you repay the investor or the seller back once you've done renovations to the home or whatever. And then you refinance with the bank. So it is tricky though on the traditional way where we used to see a lot of vendor takebacks sliding in behind major banks. It's pretty tough.
Why are many banks not allowing second mortgages?
I think the issue is that if there's a first and a second mortgage on the property, if let's say that you are the bank and the borrower is paying you monthly and you're good, but then the borrower stops paying the second mortgage holder, the second mortgage holder can initiate a foreclosure, and the first lender might not want that. So that's one of the issues. Now, the first mortgage holder has a lot more control in that situation, but it's not an ideal circumstance. one of the things that also the banks don't like is they usually don't like the higher indebtedness of the borrower, right? They don't really want to be allowing people to buy rental properties with only 10% down right now. They view that as a circumvention of the rules, which is that you need to have 20% down to buy a rental, not just 10%. And so when CMHC changed the rules a number of years ago and said, hey, we need 20% down minimum for a rental, the banks aren't really super keen on advancing people more than 80% of the value and allowing them to get more than 80%.
Christine was the one that asked that, and has a follow-up was, how can we get around it?
Yeah, of course. Okay. All right. So how do you get around it? You can't use it for down payment. Okay. But even though the lenders don't allow you to have a second mortgage behind them, it doesn't mean that they can necessarily stop you. Okay. So if you buy a property and get 80% financing on it, if you go get a second mortgage registered at a later date, then you can possibly get away with that, but you have to use a different notary or lawyer than the one that registered the bank's mortgage on the title. And that's because in that situation on a residential mortgage, the bank or the lawyer represents both the bank and the borrower in that transaction. And so they represent the bank in perpetuity on that mortgage that they registered. So if you wanted to register a second mortgage at a later date, you have to use a different notary or lawyer who does not have an obligation to tell the bank because they didn't represent that bank in that transaction.
Gotcha.
Yeah.
Along the lines of creative financing, I've heard a lot of stuff chatter about AFS, agreements for sale.
Mm-hmm.
Are you typically involved in that, or what would be your advice on getting involved in that?
It depends. So there's a lot of different structures for an agreement for sale. Would you be talking about a rent-to-own structure, or like what type of structure would somebody be looking at specifically?
Call it, it could be rent to own, it could be income property, it could be recreation property.
Yeah. Yeah. I mean, there's lots of ways of doing that, but at the end of the day, I don't get involved until title changes hands and then a borrower needs to borrow money, right? So, so that really what happens though is if you enter an agreement for sale, regardless of the date that you're planning on entering it, you should probably make sure that you can actually close on that at that date. And so you have to have some kind of game plan in play. It's not prudent right now to just assume that you're going to sell the contract at a later date and make a profit. You have to make sure that you have some kind of exit strategies where you can either close or you have some backup.
Cool. There's a bunch of other questions in here. Guys, if you just want to like open up your mic kind of like in sequence here. Debbie, it looks like you're first. Quick sec.
You might be easier just to ask them.
Where's Dave? You wanted me to ask my question?
There we go. Yeah, please.
Yeah, Kyle, I was just wondering, when you were mentioning about that Scotia's not allowing HELOCs, what about, do we, if someone's refinancing, like using refinancing to get money and then using that as a down payment, do we need like 3 months to wait for that? Or can they just, take that money and then use it as a down payment?
Yeah, we actually had an example of this with Scotia about 2 weeks ago. So we were completing a refinance on the client's residence, and his intention was to then use those funds to buy a rental property later on. And Scotiabank said, well, we can't use the refinance money in order to be able to do this. However, what we could do is we went through and scoured the client's bank accounts and asked him for statements of everything that he had. And if we can show that he has assets in the amount of the down payment, at the end of the day, it's one thing to show that you have the money for down payment, and it's another thing to show where your money is actually coming from, right? The bank doesn't track where your money actually is being written, where the check is actually being written from. But the bank does need to see that you have other assets in the amount of the down payment in order to work. And that's really, it's just a Scotia related issue. It's not other banks having this problem, but that's something that we've been using to get around it. So if we can show that you have enough assets for the down payment, even if you intend on using your line of credit, but we can show that you've got $100,000 in the bank, then we're good.
But it's only Scotia right now that's doing that. The other lenders haven't followed suit.
It's only Scotia, but I will say that we've been using Scotia a lot because they're the only major bank that's not using the line of credit limit to calculate your debt servicing. They'd use the line of credit balance instead. And so we do find that a lot of deals fit there because a lot of our investors get a big line of credit on the residence and then use that for their down payment on rental properties. Whereas with Scotia, we don't have that issue. So lately, we've been finding that we've been trying to do more deals with a few credit unions who unfortunately are a lot slower and have been hit a lot harder with timelines. Like one lender that we've been working with is a credit union, and on refinances, we've been waiting on a few refinances for like 6 to 8 weeks to get approved, which is kind of crazy. So there's a way around it, but yeah, one way that we've been able to get around that is to refinance with a different lender, put the money into the bank account, let it sit there for 90 days, and then show Scotia that they have cash in the bank account, right?
It is getting at 7:30 here, guys. I don't respect Kyle's time. I know he's staying late at the office for us. I do have one last question, Kyle, and then I'll let you close it out. What are banks looking at these days for rental income? I know, usually they take 40% or 50% or 75%. What are you seeing these days with COVID and things like that?
Yeah, so the lenders that used to use a higher percentage have cut back. So here's the range. Most lenders take 50% of the rental income and add it to your income. And then they want about 40% of your income to be used towards all of your debts. And so really they water it down to effectively 40% of 50%, which is 20%, which is not much. So on $1,000 a month in rent, they'd use $200 of it, which is only going to be about 40 grand in borrowing power approximately, like not a whole lot, maybe 50 grand. Now, that being said, on the medium end of the range, some lenders will take 50% of the rental income and subtract the mortgage payment. They don't take any strata, property taxes, or anything like that into account. We would call this an offset because it's not being added to the income first. So it's not being watered down, that additional step. So it's actually 50% of the rent in that case. But because they don't use the property tax or strata fees, it becomes a bit more. On the higher end of the range, the highest right now is 80%. So that's an 80% offset where they use 80% of the rent.
Is that normally credit unions that are doing that?
Yeah, one of the credit unions was for a while actually using, believe this or not, 100% of the rent if you had 4 or less units, 90% of the rent if you had over 4 units. And they actually moved it down twice. So when COVID hit, they just said, 90% on everything. And then a few weeks later, they said, no, never mind, 75% of the rental income on everything. So, wow. Yeah. I don't know why they're using 100% of the rent. That's not prudent at all, but okay.
Favorable, but awesome, guys. We're actually, like, Randy and I have been talking a lot over the last couple of weeks about doing more of this, like, short version Q&A, where it's just a meetup specifically built around just Q&A. Instead of doing a presentation, you can hop on to be a topic, whether it's financing or VTBs or whatever, and just have like a short and sweet hour where it's like pop, 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 and get the question that you want answered. And so if that sounds interesting to you, hit us up through email, put it in the chat here, put it into recommend it in our Facebook community or something, because it's something that I think would be really beneficial for a lot of people just to get the one answer they need and listen to a bunch of other things and be able to get a lot of impact out of it. I want to thank you all for joining. Just hang tight real quick as we go through this. If you want to connect with Kyle and everybody here on this call and a whole bunch of other people across Canada, jump into our social medias. YouTube's been going off. Facebook's always great. And Instagram, always get good reviews. Please leave us one as well if you enjoyed this. Join our Reinvestor community. Make sure that you're engaged in that. Lots of awesome content happening there every single day. Check out our
hangs out there.
Kyle hangs out there all the time. Yeah. He's always giving her. I don't even know if you sleep, man. You're always in the office.
Not much.
You got a little cot set up in the back.
Yeah.
Check out our mastermind if you're into it. You can click on the link. I'll put the link in the chat again, and we'll most likely promote it again through our Facebook community, and pretty much everyone will see a lot of attention on this. It's going to be epic. You guys are going to want to check this out for sure. Our next meetup, we're going to go all the way through the summer, all the way through the year. This year is a little bit special because of the COVID situation. So book August 18th in your calendar. And every third Tuesday, doesn't change, same time, same place. And it'll most likely be another kick-ass speaker, us, and a great community, of course. And then just want to say thanks. If you want to connect with us, here's all of our handles. Here's the way to do it. Randy and I are always talking to people in our community. You guys are our priority, and you can connect with us any of these, which ways, whichever works best for all of you.
Before you sign off, just give Kyle some love. If you enjoyed tonight, as presenters, we always love just seeing the feedback and seeing how the value came out. Kyle put in a late night for us, and we really appreciate it. And that makes it worth it for him to keep coming back, is just seeing the thank yous and things like that. If he took some value away, he would greatly appreciate that. Again, if you have questions for Kyle we didn't get to you, hit them up at info@thegreenmortgageteam.ca, and he'll be able to answer them. Anything left, Kyle?
No, I think that's good. Yep. I'm going to try and answer some questions in the chat here real quick before I log out. And
sounds
along
great.
with connecting with him, give him your business. He's a great dude. He wants to be able to keep doing this. So let's make sure that we're supporting each other. All right, guys, I'm going to hit the end of the record. And for you guys watching the replay, sorry, you got to be live. And we'll just hang out for a couple more minutes, and Kyle can answer some questions. Thanks, everybody, for tuning on.
Thanks.